right, I hope everybody is hearing me loud and clear. This in the accounting cycle, if you guys remember the accounting cycle where you have your source documents and you start with your journals and your ledgers, post the ledgers, which are your T accounts. We did the trial balance, and then we had skipped this and we went on to do the final accounts. So we're coming back now to the fourth step, but the fourth step is usually what we call adjusting or closing entries, and that is what we're starting. So adjusting entries are entries made at the end of the accounting period to allocate revenue and expenses to the period in which they belong. So that could be still a little confusing, but as we go on, hopefully it will become more clear to you. The emphasis is in the accounting cycle. It is made at the end of the accounting period. Remember, we use the source documents like your invoice, your credit notes, your debit note, your checks, your receipts. Those source documents we use to put into your journals. And we had 7 journals, which would be your sales journal, purchases journal, return inwards, return outwards, cash book, petty cash book, general journal. I think I called all. I hope you called all in your head. But we put it in our journals, and then after that we put into our ledgers. We have 3 ledgers, 3 ledger books, which would be your sales ledger, purchases ledger, and your general ledger. And your sales ledger has your accounts receivables, your purchases ledger has your accounts payables, and the general ledger has all your real accounts and nominal accounts, so everything else. I don't know, I hope this jogging your memory and stuff like that. And then we did a trial balance, which was the list of all of the debits and credits. Now these two, every time a transaction took place, every single time during the period, during the year, we would put that transaction in a journal according to what the transaction was, and we will put it in a ledger after that according. So everybody had an account and you would just enter it as it occurred. Trial balance is what you do at the end of the year. You take all these balances, so you balance at the end of the year, and then you put the balances in your trial balance, your debit balances for assets and expenses, and your credit balances for the liabilities, income, and capital. That is what we had just done. So hopefully this is very clear now, because we spent a lot of time, sorry, not that one. We spent a lot of time on the trial balance. This is done at the end of the year. And this is also done at the end of the year. So these two are done during the year. 1, 2, 3, you keep on doing this. And then when the year end comes, you do a trial balance to see if it balances, to make sure that as far as you can see, things are correct. And then this that we are going to do, we do at the end of the year as well. And then, of course, you know, your final accounts, your income statement and balance sheets, you do at the end of the year. So these adjusting entries, which we are going to do, is done at the end of a period. And why are they necessary? The income statement is prepared to calculate the profit for a specific period. So like for a year. So therefore, the rule is that the revenue and expenses used to calculate the net profit must belong to the same period that they are doing the income statement for. So if it is that you're doing the income statement for 2020, the revenue and expenses used in the income statement must also belong to the period 2020. Hey, you'll get that one? That's an accounting joke. Yes, accountants have jokes too, right? It's a cruel world. This is what we're going to be going into. You're going to get one of your first concepts, and we're going to emphasize the concept or the rule, the accruals or matching principle. So you're going to remember this one, because that is what accruals and prepayments are based on. It's a rule called the accrual or matching principle. And that states that whenever you are calculating the net profit in the income statement, you record expenses incurred. So you remember this word, expenses incurred, even if the business has not paid as yet. So is expenses incurred or used, even if the business did not pay as yet? And you also record revenue earned, even if the business has not received that money as yet. So you're going to have to learn 4 types of what we call accruals and prepayments. So accruals and prepayments is what we are going to go into. It's the first of 3 adjusting entries, because we have something called depreciation for anybody who has done lessons and they have moved ahead because they have been working with Form 5s. You would have heard about depreciation, and then there's something called bad debts and provision for bad debts. But we are starting with the accruals and prepayments. And there are 4 types of accruals and prepayments that you're going to have to learn. It's accruals and prepayments. And these adjusting entries, in case you didn't realize, they have to do with expenses and revenue. So the expenses and revenue is what we're going to be focused on. And for accruals and prepayments, therefore, they would have an accrued expense and a prepaid expense, and they would have an accrued revenue and a prepaid revenue, which equals the 4. Accrued expense, accrued revenue, prepaid expense, prepaid revenue. And what we were going to learn and emphasize is accrual is another word for owing. And prepayment is another word for when you pay in advance. So what we're going to do is we're going to take each one separately. We're going to break it down into the 4 parts: accrued expenses, accrued revenue, prepaid expenses, prepaid revenue. So we are going to go into the adjusting entry for the expenses, of which there are 2, which would be the accrued expense and the prepaid expense, adding this adjusting entry. But your expenses would be like these things like gas and water, utilities, electricity, interest on loan. I hope everybody is now reinforced that interest on loan is an expense. Insurance, rent, salaries, carriage outwards. I don't know if you guys can remember the other expenses, but all those expenses, that is what we are going to be dealing with. And the expenses in the income statement must belong to the same period. Therefore, the amount entered in the income statement is called the amount incurred or used for the same period. So what does incur mean? Incur means to become liable to pay. It means you have to pay it. And why would you have to pay it? You pay it whenever anything is used. So we are using, let's use, for example, we are using the computer right now. What expense would we have to pay because we are using the computer? I don't know if anybody wants to unmute so that I know that at least you're kind of getting what I'm saying, because this is better when it's an interactive class, but it is what it is with COVID. So does anybody want to give an example of what expense is being used up now or incurred by us having online classes?
Miss electricity.
Excellent. Electricity, is that Jimmy?
Yes,
Oh,
miss.
all right, cool. All right, so electricity. Anything else? Anybody else?
Yeah, miss, your Wi-Fi bill.
Excellent. that is also being used up. So that means that you're going to get a bill because of all the Wi-Fi, the internet that you're using. Great. So those are the two main ones that you are using up and are becoming, we're going to use the language, it is being incurred. As we sit down here and we do the online classes, those two things are being incurred. So, well, this was just some examples. So like for your car, we would have said, what are some of the expenses incurred when you're using your car? Gas, of course, use up your gas, and your insurance. Anything else? Well, you will have to pay for repairs, maintenance, because you're using your car. So those things are being incurred. For a house, you have all your utilities, like your water bill, your electricity. You have insurance for house as well. Whenever you use a machine, you also have to use the electricity. Your air condition, it will be electricity and maintenance. Or for your house or building, you're also incurring rent. This one is an extremely important one. So for like your lessons teachers and stuff, whenever they giving their lessons, they actually paying rent for whatever building or stuff that they are using. So when they use it, they incur rent. So incurred and paid do not mean the same thing. So we need to emphasize this one. Incurred, which is your new term, and you're going to be using it a lot as accounting students. Incurred is not the same as paid. Because as we just said, we are incurring electricity and internet bill, the Wi-Fi. Have we paid it as yet? No, we haven't. So there are two different things. Because expense incurred and expense paid have two different meanings. Expense incurred may be more or it may be less than the actual expense that is paid. That is why we have to do what is called the adjusting entry. Because what we're saying is that for the income statement, the amount that has to go into the income statement is the amount incurred rather than the amount that is paid. So you're going to use an example. It may not be the clearest bill. You guys can always ask your parents if they can show you one of the utility bills. The electricity bill, I like to use, you see this word usage? You remember what we said? Expenses are incurred when you use something. So it's the same for the electricity bill. That is how you get your amount that is incurred or used based on how much electricity we use. And we have the meters. I'm not exactly too familiar with it, but we have meters outside with the lines and all that, and they check those meters, and the meters will tell you how much you used, and that will give you the amount that you therefore have to pay, because that is the amount incurred. So for this bill, because of usage, you would see that the amount incurred based on the usage for the period is $159.16. Have we paid that as yet? Not necessarily. So in this case, we're going to assume we just got our bill, and therefore we have not paid it as yet. However, that is the amount incurred, and that is therefore the amount that's supposed to go into your income statement. So because the amount incurred is not always the same as the amount paid, if the amount paid is less than the amount incurred, then this is our first adjusting entry. You therefore have what we call an accrued expense, meaning that we still owe money. So whenever the expense is incurred, we have to pay it. Until we pay it, that means we owe it. So whenever you see accrued means owing or outstanding. If the expense paid is more than the expense incurred, this is called the second adjustment, which is a prepaid expense. Prepaid means that you paid in advance. So if it is, say, well, we're going to do some examples. Before I explain, let's see with the examples if you understand, and then we will explain a little bit further. So accrued expenses are expenses incurred in a period but not yet paid by the end of the period. So by the end of the period, when you're going to do your income statement that has your revenue and expenses, if by that time the expense has been incurred but not yet paid, that means you have what is called an accrued expense or an expense owing. In other words, accruals are when the amount paid is less than the amount incurred by the end of the period. So you're seeing it a different way. Expense paid less than expense incurred equals an accrued expense. This is going to be an emphasis. So being introduced to you, but the more that you practice it, you're going to understand it more and more. So expense paid less than expense incurred means you have an accrued expense or an expense owing at the end of the period. So looking at our example, you will see once again, the amount incurred was $159.16. Let us assume that we paid $100. If we paid at $100 in cash, $100 is less than the $159.16. So which means we did not pay all of the amount of our electricity incurred. Therefore, since it is less, we are still owing $59.16, and that is called an accrued expense. It's your accrued electricity of $59.16, which means you are still owing $59.16. As easy as that. So basically, which is the incurred amount? The amount on your bill. Why is it incurred? You used up that amount of electricity, so you have to pay that amount. We only paid $100. $100 is less than the amount incurred of $159.16. So that means that you have an accrual of $59.16. Just remember, accrual is when the amount paid is less than the amount incurred. Keep that one in mind, right? And also keep in mind that the amount that goes into your income statement is the amount incurred. So we're gonna do a nice little, hopefully it's nice little quiz thing here. Rent owing of $500 is known as, anybody can answer, or as long as you do it kind of quickly. So that would mean all the people that have answered.
B.
B or A? Sorry, what you said?
It's B, Miss.
B.
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 Right, so it will be B. Yeah, that sound you hear is their idea of applause for all of you that have used PowerPoint before. Okay, this one is a lot more information. If rent incurred, so if rent incurred is $1,200 for the year, and the amount paid is $1,000 by the end of the year, what is the accrued rent?
A.
200.
A.
800. Well, let's see. If rent incurred is $1,200, same information, but the amount paid is $1,000, what is entered in the income statement?
B.
B. Going through this real fast. If a business rents a building for $200 per month, but has only paid $2,000 by the end of the year, what rent is entered in the incomes.
C.
Well, Shirley going so fast. All right, is there anybody that did not get this? Because it sounded like everybody got this. Basically, it's the amount incurred, and since they gave you 1 month, but you need to know for the year, it will be 200 multiplied by 12 months to give you the amount for the year. So you correctly got the answer as 2,400. If a business rents a building, same thing, same question, but they're asking for a different, they're asking a different question, so same information. How much is the accrual?
B.
C or B?
B.
B?
Yeah.
Everybody says B?
Okay, B. Tina?
I heard somebody ball C. I heard somebody ball B. So let's take it.
D.
If the rents the building for 200,
This is D.
E.
but paid 2,000, what is the accrual? In other words, it's still owing.
Miss, I think it's D.
Okay.
D.
And I heard everybody.
D.
E.
When I call out,
D.
who says A? Who says B? Who says C?
I think it's D.
Who says D?
E.
D.
Is the answer?
It's D.
Is B?
D.
Is B. So let's explain that one. How much is the amount incurred? 200 multiplied by 12, which was the 2,400, which we had done in the previous one. This is the amount incurred, 2,400. This is the amount paid, 2,000. The amount paid is less than the amount incurred. And how much is it less by? 400, which means that they are still owing 400. So that is how we got 400 for this one. All right, so we're moving on to the second one. Remember what we just did is the accrued expenses. Prepaid expenses are expenses paid but not yet incurred. In other words, prepayments are when the amount paid is more than the amount incurred by the end of the period. And this is just another way of looking at it. The amount paid is greater than the amount incurred. For your accrued, if you remember, the amount paid was less. So you still had owing or accrued. In this case, the amount paid is more than you were supposed to pay because of what was incurred, which means that basically you paid in advance. So our example, we still have the amount incurred as 159.16, but let us assume that we went and we paid in TNTech, we went and we paid $200. $200 is more than the amount incurred of 159.16. How much more? It's $40.84, which means that we have a prepaid expense of $40.84. So I think that is simple enough. When we go in more into it, how you can understand is your prepaid phones. When you think about it, you pay more than you have used up, because when you go and you buy your card, you haven't used the phone as yet. So which means that you're paying before you have even incurred a bill. So that is an example of a prepayment. That's why they call it a prepaid phone. See that? Right, so you have come across the term prepaid already. Just remember your phone, and that is what an adjustment is. Prepaid expense, Same thing as your prepaid phone. They call it prepaid phone because you're paying in advance. Just like with this bill here, you paid $40.84 in advance. So we go to the questions again. Just remembering, once again, prepayment. So when you pay more, and the amount that goes into your income statement still remains the amount incurred. Right, so Homes Guest House pays electricity of $6,000 for the year. In other words, this is the amount that is incurred. At the end of the year, the guest house paid $6,500. What is this adjusting entry? Is this an accrual or a prepayment? And is it a accrued expense or prepaid expense, depending on which one it is?
Miss, a prepaid expense.
It's a prepaid expense. And you knew that because you paid more than the amount that was incurred. This is going to become more difficult when we start to mix it up, right? So if a business rents a building for $2,400, but has paid $3,000 by the end of the year, what is the prepayment?
$3,000.
Nope.
Miss 600.
3,000. Remember, the question is how much is the prepayment?
1,000.
So let me ask, what does this 2,400 represent? Prepayment incurred
Good.
or paid? Right, incurred. What does the 3,000 represent? Incurred, prepayment, or paid? Paid.
Paid.
So the 3,000 is paid. So how would we find the prepayment? The prepayment is when the both adjustments. Let me point out what you are comparing is the amount incurred and the amount paid. So this is the information you're always looking for the accruals and prepayments. The amount incurred and the amount paid. And if the amount paid is more than the amount incurred, you know you have a prepayment. And how much is the prepayment is always the difference between the two. Same for the accruals. What is the accrued amount? It will always be the difference between the two. So in this case is a prepayment. What would be the prepayment? Would it be the 3,000? No, this represents the amount that is paid. So what would be the answer for the prepayment?
600.
It will be 600 because this is incurred, this is paid, this is more by $600. So your prepaid will actually be the 600. So if a business rents a building for $200 per month, but has paid $4,000 by the end of the year, what is the adjusting entry? So remember, you take it one step at a time. You compare certain things. In this case, you have to work out something. So I will give you a little time and then you can give me, oh, I had a mistake here. So you only have 3 options.
A.
Somebody gave me the answer of A. I'm going based on what yay, cool. A. Is there anybody that didn't get the A? 200 by 12 will give you 2,400. You paid 4,000, which is more, so it's a prepaid expense. How much more did you pay? 4,000 minus the 2,400, and that gave you an answer. Excellent. Answer of 1,600. So you end up with a prepaid. So the first thing you could have found out, was it prepaid or accrued? Since this is more, then you worked out here as the 2,400. Then you knew that the options were prepaid, and then you just had to find out what the amount was by taking it away. Okay, if a business rents a building for $200 per month but has paid $4,000, what is the amount that goes into the income statement?
2,400.
2,400. Excellent. All you had to do in this case, you didn't have to do any comparisons. You just had to work out the amount that they rented for. Okay, so we're going to go on to the revenue, and the revenue should be just as easy because it's just the flip. It's the same thing as in the accruals, is the amount owed, which means that instead of paying in this case, it's you're receiving. So we dealt with expenses, which is the cost of using an asset. Income or revenue is just the amount that you earn from doing your business. So your main income or revenue is when you sell your stock. That is sales, right? When we sell stock, we can sell it for cash, check, or we did on credit. Remember, we did the on credit. So these are the three ways that you can earn your sales. Notice that the credit one, you have not received any cash because check is considered like a near cash, right? But you have the instances where you can actually sell on credit. Did you earn that money? Yes, you did. Because once you give them that stock, once you sell them that stock and they have received that stock, they have, the business has therefore already earned that revenue. It's just that when they sell it on credit, they just have not received it as yet. So this is why all three, once you have earned it, this is the amount that is earned, and this is the amount that will go into your income statement. And that goes for all of your revenue. Like, for example, when we were doing the income statement, you realize all the receives. So commissions received, dividends received, interest received, rent received. Once it's received, that was your income. You identify that as income in terms of your ALICE. And all of this, it is the amount that is earned, even if we have not received that money as yet. Just like with the expenses, it was the amount incurred, even though we did not pay it as yet, or we paid more. It is whatever is incurred. For revenue, it is whatever is earned. So the revenues used to calculate net profit must belong to the same period. Therefore, it is the amount earned rather than the amount received. Is the amount earned that you have to put into your income statement. So we have our third adjusting entry. It's just that we have now moved on to the revenue part. So you had your accrued expenses, prepaid expense. Now we have the third one, which is accrued revenue. And accrued revenue are revenues earned but not yet received, which means it's still owing. So in other words, the amount received is less than the amount earned. So in our example, we have is a plumbing business. Yes, we are plumbing business, and we went in and we did some work, and we ended up earning an amount of $2,844.80. So once again, we are the plumbers. That is our business, and we earned $2,844.80. Did we receive that amount? We don't know as yet. We're going to go into examples and make certain assumptions. So once again, how much did we earn? And therefore, this is the amount that has to go to our income statement, $2,844.80. We earned that amount, but we only received $2,000. $2,000 is less than the amount that we actually earned, which means that we have an accrual or an amount still owing to us. And how much is still owing to us? The difference between the amount we earned and the amount we received, which is $844.80. which means that our accrued revenue is $844.80. So I hope everybody gets this one. Is the same as the accrued expense, except you're dealing with revenue in this case. So once it is less, once you received less, that's accrued. Then we have our last or fourth adjustment, where we have our prepaid revenue. Prepaid revenue is also known as unearned revenue. And this is when you have received revenue in advance, but you have not earned it as yet. So as we go into this more and more, I like to use the example of lessons teachers, because if you're doing lessons, you would either be paying at the end of the month or you'll be paying at the beginning of the month. If you pay at the beginning of the month, that means that lessons teacher is earning money, is earning money after they have received the money. So they receive it. If they receive it at the beginning of the month, they have only received money that they have not earned as yet. That means that they have a prepaid revenue in that case. And they now have to teach you to be able to earn that money. Whereas teachers, we don't get money in advance. We earn our money first, and then we receive it in the form of a salary. So we dealing now with lessons teachers. We're looking at it like lessons teachers who receive at the beginning. That means they have received it before and they have not earned it as yet. So you call it unearned revenue. So in other words, prepaid revenues are when the amount received is more than the amount earned by the end of the period. So accrued is when it's less, and prepaid is when you receive more. So in our example here, it still remains we earned $2,844. In this case, we received a $3,000 down payment. So we're going to assume that before we came in and we did the work, they gave us $3,000. And then when we came in and we did the work, we actually only did $2,844 worth of work at that point in time, right, for this bill. So which means that we received more than we actually earned. So you would look at this as a prepaid revenue, meaning that they had paid this amount in advance. So we now have work for them to do with $155.20, so to speak, right? We owe them money. The review or the summary, what you have to learn are these 4 accruals and prepayments. That is what we are going to be focusing on for the next. We just have about 2 more classes. That's it for the term until September and stuff. Anybody who wants any work to do during the vacation, of course you can ask me for it. You know, I'm willing. But so accrued expenses, accrued revenue, prepaid expenses, prepaid revenue. These are the 4 that you're going to have to just remember, and it's very, very easy if you realize 2 of them: accrued, expense, revenue. Prepaid, expense, revenue. What do they have in common? Besides accrued and prepaid, expense and revenue. So it's just kind of interchanging those 2 things: accrued, prepayments, expense, and revenue. So you have the 4 of them. And how to identify, which is what we had been doing all the time. For expenses, you compare the amount paid with the amount incurred. Use the word incurred. Incurred means that you have used up whatever the expense is. Like, for example, electricity. Earned is whenever you do something to earn whatever money, like selling your goods or providing a service. And for accruals, it is less. So the amount paid or received is less than the amount incurred or earned. In other words, you are owing. And how do you end up owing? Once this is incurred or once you have earned money, you are supposed to get that money. So if you get less than that, or if you pay less than that, that means you are still owing, and that is called an accrual. If the amount paid or received is more than the amount incurred or earned, that is called a prepayment. So once again, the amount incurred or earned is how much you're supposed to get or pay. So if you get less than that, it means it's owing. But if you get more than that, it means, or you pay more than that, it means it's a prepayment. You have paid or received in advance. So this is one, just focusing. What are the two things that you're going to be comparing for the activity that you're going to get, which is very easy. You're going to finish that in no time. Amount paid or received, comparing that to the amount incurred or earned. So if they don't tell you outright, this is amount owing or this is amount prepaid, you're going to have to look for these two figures and compare them. And if the amount received or paid is less, that's an accrual. But if it is more, it is a prepayment. As easy as that. So this is the activity, and you're just going to be answering these questions. And once again, how you answer. First thing I would suggest you do is you would state whether or identify whether it's an expense or revenue, and then you can identify whether it is accrual or prepayment. So like, for example, electricity owing 200. They didn't give you the two figures in this case. They told you it's owing. Once you see owing, you know, therefore, that it is an accrual. Electricity is what? Is it revenue or is it expense? It's an expense. So that means that the 200 which they gave you is an accrued expense. And how much is the accrual? 200. So just to make it clear for those who might still be a little confused, rent received still owing $1,000. I don't know if anybody wants to answer for me. You're seeing still owing. So is it an accrual or a prepayment? Accrual. Good. So it's an accrual. So it's an accrued. Rent received, is that an expense or is that revenue? That is, because it is received, it is revenue. So your answer here would be revenue. And how much is accrued? They told you already. It is $1,000. So I'm not going to wait for you because you're going to have to go and do this again to see if you remember or get it. I want somebody to do this one before we leave. Rent for the year, $2,400, paid $1,800 cash.
Accrued expense.
It's an accrued expense, and yes. So rent is an expense, so you know the answer had to be expense. It's accrued because you paid less than was incurred. So how much is the accrual? So you have it's an accrued expense, but how much is the accrued expense?
600.
600.
Excellent. Right, so it's 600. So once again, just quickly, you compare these two. Since this was less than the amount incurred, it's accrued. Since this is an expense, it's an accrued expense. How much less was it? 2,400 minus 1,800, 600. So therefore you had an accrued expense of 600. Nice and easy, except for this one. So number 15, I'm going to leave you guys to go away with number 15. Please submit. This is just one page. You just take a picture because I'm really curious about this one. right? So number 15, I pointed out, number 15 is I think it's the only one that will give a bit of a challenge, which is fun, right? Cool. So as I said, I already put it on the stream for you to just do this, and that's it, for the week. So I would like, I'm going to post a video for you if you want to go through the lesson again, kind of. And then you can always go through your workbook and read up on some of the things in terms of this. I'll probably put something for those people who don't have their workbook, but this is your only activity for the week. So you're getting a little bit of a break. And then next week, when we go on to the next part of it, then you will get your activities again. Cool? So class dismiss, enjoy your week and everything.
Thank you.
Yeah. Okay, bye-bye, guys.